The U.S. Federal Reserve is signaling from Jackson Hole the start of a new monetary cycle of interest rate cuts. What will be the most direct consequences on financial assets of this new monetary cycle? Let's find out. The President of the Federal Reserve, Jerome Powell, has officially initiated a new cycle of interest rate cuts. In his recent conference in Jackson Hole, Jerome Powell stated that the time has come to make adjustments in monetary policy. In other words, the time has come to start lowering interest rates. It's true that Powell hasn't yet revealed when exactly the interest rate cuts will begin. However, most market operators anticipate that the first rate cut will occur at the next Federal Reserve meeting on September 18th. Moreover, most market operators anticipate that in the 4 remaining months of 2024, there will be 4 interest rate cuts, so that by the end of the year, interest rates in the U.S. will be 1 percentage point lower than they are now. Currently, interest rates in the U.S. are between 5.25% and 5.5%, and most market operators anticipate they will end the year between 4.25% and 4.5%. So what can we expect as the effects of this interest rate cut on different types of financial assets? If we apply the ceteris paribus clause, meaning if everything else in the economy remains constant except for the interest rate cut, although this isn't a realistic assumption, because the rate cut will modify many other aspects of the economy. The effects would likely be as follows. First, a cut in interest rates benefits longer duration financial assets, i.e., those assets that provide most of their cash flows in the distant future. Interest rates represent the opportunity cost of waiting for those future cash flows. If that opportunity cost decreases, then those assets that are expected to provide most of their cash flows in the distant future become more valuable. Within this category of long-duration assets, we find various investments, such as long-term fixed income or shares of tech companies that have yet to prove themselves, meaning they are not generating profits today, but are expected to generate significant profits in the future, commonly referred to in stock market jargon as growth stocks. Not only that, but judging by what we've seen in recent years, it seems that so-called crypto assets, or at least the vast majority of them, also behave like long-duration assets, meaning investments whose returns are expected to come in the very distant future. Therefore, a sustained cycle of interest rate cuts, if it does not affect any other structural elements of the economy, should tend to be positive for this type of investment. However, bear in mind that this is public knowledge, that is, it's something that everyone, or almost everyone, knows. Therefore, the positive effect it may have on the price of these assets has largely already been discounted in previous quarters, because although the start of the rate cut cycle has now been made official, most investors were already expecting this rate cut cycle to happen sooner rather than later. Secondly, this Federal Reserve interest rate cut also means that short-term financial assets vehicles in which investors typically deposit their liquidity will provide lower returns than they have so far. For conservative savers, it will become more difficult to earn a return on their savings held in liquid instruments. Short-term public debt, money market funds, or bank deposits will pay lower interest rates than they have been paying in recent years. Initially, this effect will be barely noticeable, But as interest rate cuts continue, this cumulative effect will become much more significant. The reason for this is easy to understand. So far, the Federal Reserve has wanted to combat inflation, and to do so, it needed to moderate aggregate spending within the economy. One way to moderate aggregate spending in the economy is to incentivize people to keep their income and interest-bearing liquidity. Now that the Federal Reserve is deprioritizing, at least to some extent, the fight against inflation because it considers that the battle is already won or nearly won. It will reduce the incentive, the reward that economic agents receive for keeping their income in liquid assets without spending it. This means that conservative savers will either have to settle for a lower return on their savings or start spending part of those savings because it will no longer be worthwhile to keep those cash balances due to the lower return they receive. Alternatively, they may seek other longer-term or higher-risk assets that offer higher interest rates. In fact, this is something the Federal Reserve is trying to achieve, to encourage conservative savers to move to other types of financial assets that are longer term or riskier in order to boost financing for this type of investment. This means that a larger portion of the savings currently held by U.S. citizens or citizens from the rest of the world who save in dollars that are in cash balances or liquidity will be redirected either to long-term bonds, the stock market, or other types of long-term or higher-risk financing instruments. Finally, the third financial consequence of a dollar interest rate cut is a relative weakening of this currency compared to other currencies. Every investor has to decide within their liquidity portfolio whether to hold a particular monetary asset, such as dollars, or another type of monetary asset, such as euros. The higher the return they get from holding dollars compared to euros, the more likely they are to include dollars in their liquidity portfolio over euros. Of course, I'm not saying that the only factor determining which monetary asset is included in an investor's liquidity portfolio is the interest rate. In many cases, it isn't even the most important factor, but it is certainly another factor to consider. If the dollar's interest rate decreases relative to other monetary assets, then, on the margin, the dollar becomes less attractive than other monetary assets. This could also include gold, which is also a global monetary asset and non-state monetary asset. If the interest rates paid by fiat currencies decrease, the relative attractiveness of gold increases compared to fiat currencies. And, of course, we must remember that other fiat currencies have already started or are also about to start a cycle of interest rate cuts. Therefore, even if the dollar cuts its interest rates, if other fiat currencies cut them even more, then the dollar could end up relatively strengthened against them. But what I'm saying is that the marginal effect, the specific effect of this dollar interest rate cut, ceteris paribus, isolating it from other economic effects, is a relative loss of attractiveness of the dollar, and thus a relative loss of the dollar's strength and value compared to other monetary assets. In conclusion, the most immediate and direct financial effects of a cycle of dollar interest rate cuts are, first, an increase in the attractiveness of long-term dollar-denominated assets. Second, a reduction in the returns of short-term dollar-denominated financial assets. And finally, a relative loss of attractiveness of the dollar compared to other monetary assets, all of which, again on the margin because many other factors are involved, contributes to higher inflation. It remains to be seen how far and for how long the Federal Reserve will be able to continue lowering interest rates. That's all for now. Like and subscribe to support the channel, and see you next time.